Lean accounting really emerged as an obstacle to lean transformations a number of years ago. And it really, at its fundamental core, revolves around the fact that traditional accounting views inventory as an asset, a good thing, something of value to the business. And as I've stated before, really the heart of lean and the core driving principle is reducing the timeline from when you begin to do something until you finish. Reducing that timeline directly gets at inventory. If it takes you 3 weeks to make something and you can reduce that down to 1 week, that means you're going to have only 1/3 as many in process. It means only 1/3 as much inventory. So when the lean people are trying to reduce those cycle times of processes, the accounting people are jumping up and saying, wait a minute, you're diminishing the assets of the business. And what lean accounting emerged as a common sense answer to that, and saying among the manufacturing people, look, we really don't understand all the ins and outs of accounting, but if we're spending less money, that has to be a good thing. And lean accounting really emerged as a new approach to accounting that really is more aligned with lean principles, that says, no, inventory is not really an asset. Inventory is really something that's used to hide a lot of waste in the organization instead of bringing it to the forefront. So lean accounting is accounting that's aligned with lean principles. That really means it's aligned with cash flow. It essentially says profits are derived by generating more cash faster, not by accounting allocations and assignments and numbers games. Lean reporting, the lean profit and loss statement that comes out is radically different from the typical one because it doesn't have all of those allocations, and it actually has real numbers. It actually has how much money came into the business and how much money went out of the business without anything being allocated and assigned off to these other accounts. So it's much more like your family budget. When you sit down at the end of the month and say, how was the month? Lean accounting is pretty much the same way. How much came in and how much went out? Was it a good month or not? An exporter can use lean accounting as really a starter to lean, because what it does is it begins to measure where all of the waste is and where all the loss is. If you start to generate financial statements that no longer say inventory is an asset, but inventory is a great big pile of cash that's being drained from the company on a regular basis, under lean accounting, that looks like the serious problem that it is. And that leads the company to go start to apply lean tools, and the lean processes make a whole lot more sense. The current financial practices that are required both in New Zealand and in Australia, the United States, everywhere else, are all in compliance with what are referred to as GAAP, generally accepted accounting principles. And as the financial and business world has become more integrated, New Zealand, as well as everyone else, is converting to what they call IGAAP, International GAAP, and essentially saying, even though we were all doing it about the same, now everybody's going to do it exactly the same. So an investor in the United States can look at financial statements that are coming out of New Zealand or from Germany or anywhere else and understand that they were all calculated with the same rules. And those financial statements, those generally accepted accounting principles, are the polar opposite of lean accounting. And so an exporter in New Zealand who's being driven by their GAAP compliant financial statements, as the law requires them to create, is going to have a hard time becoming lean. You have to create those GAAP statements, but you don't have to believe anything that's in them. The important part of lean accounting is that you don't let what the outside people demand to see be what you're going to use to run your business. It certainly is onerous to have to maintain 2 sets of books, but I think it's important for companies to sit back and take a look at what's really important to them. Is the objective of the business to make life easy for accountants? If everyone else is supposed to conform what they're doing in order to make accounting less onerous, well, that's a completely different business objective than I think most companies think they're all about. And my view is that if the accountants have to do 2 sets of books in order for the company to be effectively managed and to obey the law, then so be it. That's too bad. But to say that we're not going to have intelligent numbers and meaningful numbers for management to make good decisions because it's too onerous for the accountants seems like a rather misguided way to run the business. I think the accountants need to find ways to get more efficient at satisfying both sets of books rather than to say, it's too hard, I don't want to do two sets. And they're not really two sets of books. They're two ways of describing the same thing. The same events took place. It's just a complicated reconciliation back and forth to balance what the two different sets of numbers are saying. The key obstacles to adopting lean accounting are more psychological and cultural than anything else. It's a difficult change mentally for some senior executives to make. And the only solution to that is to demonstrate the results, show them the lean accounting statements in parallel to theirs, give them an opportunity to test drive them a little bit and get a higher comfort level to go forward with lean accounting. Probably the one key to success in a lean transformation or a lean accounting implementation is to have the senior financial people fully committed to the process and not just knowledgeable about the lean accounting part of it, but knowledgeable about the lean transformation in its entirety, and for them to see the critical role that they can play by being out in front leading this effort. Globally, lean accounting is really starting to take a life of its own. It's actually only been 6 or 7 years since it was first brought out into the market in a big way. And initially, companies were using lean accounting as a primary driver and the organizer of cost to reduce cost. More recently, where the trend is going, that companies are using it to transition into pricing and using lean accounting techniques and tools as a strategic pricing weapon to go out and get away from basing their price on some accounting calculation of cost, but basing their price on what it needs to be in order to succeed in the marketplace. Essentially saying, what does it take for me to sell you this widget that you're buying from Australia for $5? If the answer is I need to be at $4.50, then that becomes my price. And then lean accounting takes that number and blows it on down and says, okay, this is the way the cost structure has to be in order to be profitable at that $4.50. But it essentially is energizing the whole sales and marketing side of things and enabling companies to go out and use pricing as a weapon rather than seeing cost as a hindrance. That's the big change that's happening now. What really motivates me to go out and promote lean and to teach lean at every opportunity is the fact that I've seen it succeed, that I've been closely involved and have seen the impact that lean transformations have on companies and on communities, where you see that the people who are working there are being paid better than they were before, they're getting better benefits, they're happier at work, everything is getting better and better. And you compare that with traditional management methods that are saying we need to lay people off, we need to cut pay, we need to cut benefits in order to compete, and you realize that's not necessary. That once you've seen it happen and you realize what's possible for people and for companies and for communities, it's hard not to be passionate and somewhat evangelical about it.